Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, April 19th, 2024. A week ago, I said there is not much impetus to drive stocks higher until there is more clarity regarding monetary policy. To the extent there has been more clarity since then, it is not what Wall Street was hoping to hear. The S&P 500 has fallen every day this week since peaking above 5264 3 weeks ago. The index fell below 5,000 today. And a little after closing, looks like it closed around 49.67. Now, the last time the index traded below 5,000 was on February 21st, before a series of employment and inflation data indicated the economy is stronger than expected. This week, Fed Chair Jerome Powell tamped down expectations for a cut in interest rates until inflation falls. Now, that may take a while. The bond market certainly thinks so. Over the past 3 weeks, the yield on the 5-year Treasury note has risen from 4.2% to nearly 4.7%. So here I'm going to show you a chart of the 5-year Treasury. Now, if you look at the past 6 months, it's not that noticeable. And in fact, you can see it's almost like a bowl shape. But if we go, say, in the past month, you can see bottoming out here right around the end of March, right around 4%, and then running all the way up 4.6%. Now, that's a big jump in relative terms for a 5-year maturity. And mortgage rates are also rising, which at some point will adversely impact the real estate market. That's why home builder stocks such as Toll Brothers, which I'm going to show you a chart of here, are down more than 10% since the start of this month. Now here's Toll Brothers again, doesn't look that bad, but when we zoom into like the past month, you know, there's a noticeable peak here and then the drop. Automobile manufacturers such as General Motors and Ford are also down by a similar amount for essentially the same reason. Now here's General Motors. Again, this is the past 6 months, but if we zoom in on the past month, again, you can see a peak at right about the same time, end of March, and then the drop. And the reason's simple. The cost of borrowed money is going up, which reduces spending on items bought on credit, especially big-ticket items like homes and cars. This is not the end of the world. It is also not the soft landing scenario for the economy that fueled the stock market's rally over the past 5 months. It is more of a reality check, which the stock market needs. A strong economy is a good thing. Unemployment is low, wages are growing, and consumers are spending. High inflation is a bad thing. The cost of goods go up. But right now, the positives outweigh the negatives. That's why I believe the stock market is more likely to go through a mild correction rather than a hard crash this year. The dour mood on Wall Street may change if enough companies do not reduce their financial guidance for this year based on recent economic data when they release their Q1 results in the weeks to come. In fact, some of them may increase their sales guidance based on the rate at which the economy is growing versus what was expected late last year. At times like this, I think of the Wall Street adage, it's a market of stocks, not a stock market. Some companies will suffer more than others due to higher consumer borrowing costs. Others will not be impacted at all. Most will fall somewhere in between. Muddled thinking during times like this creates opportunities for savvy investors. When Wall Street panics, the thundering herd tends to behave irrationally for a while. When that happens, some good stocks will be for sale at discount prices. Be ready to act when a stock you like falls into your buy range. And that's this week's PF Video Update. I look forward to talking to you another week.